on Business Incorporated today. African Economic Conference begins in the Republic of Cabo Verde tomorrow. Libya and Niger sign MOU on work visa. And how can emerging markets hedge against currency risks? Find out on this episode of Business Incorporated. Welcome to the program. I'm Imi John Mekwa. Well, let's begin the program in Africa, where bearish sentiment permeated trading at intraday. It's a persisting negative sentiment at Nigeria's NGX, shedding 0.07%. Well, not as much as the loss of yesterday at this time. And once again, South Africa is on the flip side, up almost 1%. EGX 30 of Egypt followed the trend in Nigeria, but with a deeper loss of 0.27%, while Nairobi Stock Exchange of Kenya closed negative. Tuesday decreased by over 0.5%. It was mostly green trading at intraday in the Middle East. Abu Dhabi index was up by almost 1%, while Dubai's index was also positive, but just about 0.5%. Still within the region, Saudi Arabia added much lower, just about 0.34%, while Qatari index was on the high side. It was over 1.1%. And investors are looking at the prospect of a more hawkish U.S. Fed and Omicron risk. European markets are up, reversing some of yesterday's losses. We have Chiponda joining us from Berlin now to give us updates on what's happening in Europe. Hello, Chiponda. Good to speak with you again. Good afternoon.
Good afternoon, Ini.
So what should we be reading from today's market reaction?
Well, in terms of the reaction we've seen today, we definitely should be reading the fact that investors are just trying to digest what a hawkish Fed could mean for interest rates, of course, because if they increase that rate of tapering, what that could mean for the stock markets. That's what they're trying to figure out. But on top of that, they're also trying to figure out the impact of the COVID variant, Omicron, and that's something that is obviously still uncertain, just how much it's going to affect markets. We know that here in Germany, of course, we are still struggling to deal with that fourth wave of the coronavirus. And in fact, there's reason to believe that we may see further restrictions, especially in areas where the COVID infection rates are extremely high, because, of course, hospitalization rates are still rising, and death rates here in Germany have reached the highest level since February. So we've had like the highest number of COVID-related deaths in the last 24 hours. But apart from that, we've also seen a warning, or rather a signifier in terms of inflation rates from the OECD, which is related to the COVID pandemic. And they've said that the inflation rate next year could be as much as 4.4% for the G20 group of nations. And that is much higher than what they had anticipated in September. So it kind of shows that inflation is going to be increasingly a concern. And that is something, of course, that was also mirrored by the statement that Jerome Powell, U.S. Fed chair, made in front of that U.S. Senate Banking Committee yesterday. So inflation is still the big story on the markets.
Yeah, but is it possible? Could tapering the U.S. influence in the European Central Bank's policy, could it affect it?
Well, that is the question, because, of course, ECB policymakers have been, using the word transitory, or at least, using words that actually point to the fact that this is a temporary issue in recent weeks and even in recent days. So obviously, it will be interesting to see how they respond to what their peers in the United States are saying. Obviously, here in Europe, inflation rates are at the highest level in decades, and that is definitely something to be concerned about. Whether, of course, that needs intervention is a whole other question. The ECB seems to think it's not the right time yet because, of course, that could interfere with the economic recovery. But, of course, we've had experts saying that the inflation rates could stay at high levels or above ECB target rates of the target rate of 2% until end of next year or beginning of 2023. So it will be interesting to see how they respond, and we'll get an indication potentially on December 16, which is when ECB policymakers will be meeting to talk about ECB monetary policy, and that will kind of help us know what they're planning for next year and just how exactly they plan to tackle inflation, and of course if they also plan to ditch the use of the word transitory, as the US Fed chair has pointed out that we need to do that. But we'll see how ECB policymakers respond to that as well.
Yeah, well, that word again, transitory. But staying in Europe, the EU plans to invest up to 300 billion euros in the development of modern infrastructure to rival China's Belt and Road Initiative over the next 6 years. Do we have more details about this?
Yes, it is going to be 60 billion euros per year until 2027. That is what is planned, just to give you a sense of what the European authorities are planning. Of course, a lot of that is supposed to help businesses, European businesses, invest in African countries as well, and of course across the world. Because of course, a lot of European businesses especially have been complaining about the fact that they haven't been able to compete on a level playing field with Chinese firms, which of course, for the most part, receive Chinese state backing when it comes to investment on the African continent, for instance. Now, of course, this could help them. This could help European businesses compete on the African continent. But a lot of critics are also pointing out that this is a little bit too late because, of course, you know, Chinese firms have been active on the continent for the last decade or over a decade in some parts of the continent quite intensively. So it will be interesting to see if European firms will be able to catch up. And of course, another thing to point out is the fact that this investment, these funds will be also tied to some conditions like, you know, climate change goals, and on top of it, making sure that their investments are in places and countries which are democratic. Now, that's not something we see for Chinese firms as a condition. So that will be interesting to see whether that actually does really help European businesses as is hoped in Brussels.
All right. Africans are certainly waiting and hoping to see better packages coming from Europe. Thank you so much, Uponda, and enjoy the rest of your day.
Likewise, Ini.
So let's move to the United States now, where U.S. stock futures were higher in early trading on the first day of December, following a Tuesday sell-off on Wall Street over fears about the new Omicron COVID variant and the Federal Reserve mulling a quicker than planned exits from its easy monetary policy. The market seemed resistance to Omicron concerns and was also observed yesterday by our United States correspondent Maria Bird, and she gives us the details of how the market traded yesterday.
The U.S. stock market had another rough day as the S&P 500 fell by 1.9%. The Dow Jones also fell by 1.9%, and the NASDAQ fell by 1.6%. Investors are not very concerned of the new COVID-19 variant, but the Federal Reserve has also announced there could be a tug-of-war with the economy between the labor market and also the inflation rates. It is concerned more about inflation rates for the average consumer and is putting economic policies in place to ensure that inflation is kept at bay as much as possible. Investors, though, are keeping their eye out because they're expecting inflation to truly hit in 2022.
Well, let's move to the UK now. For months now, we've been discussing supply chain disruptions, a challenge that seems far from over. Well, its aftermath is telling on some sectors or the whole economy of the UK. Now we have Juliana joining us from our London studio to give us updates. Hello, Juliana. Good afternoon.
Good afternoon, Ine.
So it doesn't look like this shortage disruption is going away anytime soon, as indicated in the latest survey of the UK purchasing managers.
Yeah, that's right. We've had data from the Purchasing Managers Index looking at manufacturing. It's actually been revised down from 58.2 to 58.1. Now, this is the second consecutive month where we're seeing growth in the manufacturing sector, but the growth is pretty lackluster compared to some of the highs we saw in the summer. In August, it was above 60. Of course, anything above 50 does show that the industry is expanding. But, as you said, supply chain issues is a major problem for manufacturers. The fact that there are fewer supplies means that inflationary pressures are kicking in. It's costing much more to buy some components and some commodities. There's also severe issues with labour. Labour shortages still remains a topic of much concern in this country. Yes, unemployment is declining, but we still have over 1 million vacancies out there, some record high numbers, and some of these skilled positions are in manufacturing. There's another word which we can never get away from, and we've got to mention it at least once a week, Innie, and that's Brexit. Brexit issues and the logistics that are consequences of Brexit are still issues that manufacturers in the Purchasing Managers Index survey suggested. So yes, we are still seeing growth, but growth is being slowed down, and until some of those key areas can be addressed, we're going to start seeing this slowing of growth in the coming months to come.
All right, Juliana, just before we let you go in less than a minute, earlier we see that the FTSE seems to be resisting the concerns about Omicron. It was up this morning. How is the market at this time?
Still up, still holding on to those gains, led by some of the oil majors. Brent crude is up, so that's pushed up the stock price of BP and Royal Dutch Shell. The FTSE All Shares up 1.34%. The FTSE 100 is up by 1.31%, and the FTSE 250, that's up by 1.25%, Tinny.
All right, thank you so much, Juliana. Enjoy the rest of your day.
Thank you.
All right, so one of the issues we're discussing on the program today is hedging currency risks. So we have, and this has been the focus of a research firm which is based in London, Telima. We have one of them joining us now to tell us at this time when it seems like well, the currencies globally, we have COVID affecting currency, we have inflation affecting currencies. So we have him joining us now, the head of financial sector research of Telima, Rahul Shah, joining us to tell us their research and part of the impact or the lessons that we could learn from that. Good to speak to you, Mr. Shah. Good afternoon.
Good afternoon. Thanks for having me in.
Yeah, so your recent report looks at how investing in banks can help equity investors. What caught your interest? Why did you look at this topic in the first place?
Yeah, so I think two main reasons. Firstly, the dollar has been strengthening this year. It's up around 5% against a basket of currencies. And I think that strengthening trend is likely to continue as the US Central Bank reduces its bond purchases and also, in turn, starts to raise interest rates. So that's the first reason. The second reason is that we know from past experience that when bond markets become more volatile, that some emerging market currencies can get sold off. And I think we're entering such a period of volatility right now. So I think for international investors, particularly those that look at emerging markets, currencies are going to play a much bigger role in their investment performance going forward.
And what were some of the key findings of your research?
So we looked at around 91 banks in detail across 39 emerging markets, including 4 from Africa. And what we found was that in 2/3 of the cases, the banks are actually net long foreign currency. And this means that they can be used as partial hedges against currency weakness. So that's basically the key finding.
And then one of the names you singled out caught our attention here in Nigeria, Guarantee GT Code now, Guarantee Trust. Tell us a bit more about what you found out about that.
Yeah, so Nigerian banks are interesting because they do tend to be quite significantly net long foreign currency. And that's because one of the big sectors that they lend to is oil and gas. And that is a sector that has foreign currency earnings. So they tend to make dollar-based loans to that sector. What we've seen in the past is that when the naira does weaken, the value of those loans in naira terms actually rises. And provided the oil companies are able to service those loans, and unless there's an oil price crash, they should be able to. It means that the banks can record translation gains through their income statement. And among the banks that we looked at, GT was the most exposed to this phenomenon. And we know from GT's past results that when the currency has weakened in the past, they have been able to record these gains.
And which other markets did you look at on the continent?
Sorry,
hello, Mr. Shah.
Hi.
So which other markets did you look at, apart from the markets in Nigeria? Which other markets on the continent caught your interest?
Okay. So in Africa, the other markets we looked at were Kenya, South Africa, and Egypt. The banks in those countries also tend to be net long, but to a lesser degree than Nigeria. But I think that those hedges could actually be just as important because, for example, if we look at the Egyptian pound or the Kenyan shilling and we look at the fundamentals in those countries, there are a few sort of red flags, such as current account deficits, inflation, and the real effective exchange rate. So those hedges could actually be more meaningful in some of those other African countries. But I think the key takeaway from the research that we've done is that if you are interested in investing in Africa, but you are worried about currency risk, then do consider the banking sector as a means to getting that African exposure.
All right. Thank you so much, Rahul Shah, Head of Financial Sector Research at Telema. Enjoy the rest of your day.
Thank you.
So it begins tomorrow, and the discussion on financing Africa's post-COVID-19 development will be the talk of the town at Cape Verde. But we'll have that discussion after the break. Just stay with us. It's Business Incorporated on Channels Television. Welcome back to Business Incorporated on Channels Television. The 2021 edition of the African Economic Conference begins tomorrow in Cabo Verde. The event, which is jointly organized by the African Development Bank, the Economic Commission for Africa, and the United Nations Development Program, will run from tomorrow, Thursday, to Saturday, and discussions will be on the theme, Financing Africa's Post-COVID-19 Development. But we do have our correspondent, Amarachi Ubani, there covering the event. She will join us subsequently to give us updates. But for today, we'll have Mr. Bartholomew Ama. He is the Director of Macroeconomic and Governance Division of the United Nations Economic Commission for Africa, joining us to tell us the feel just before the event. Good to speak with you, Mr. Ama. Good afternoon.
Good afternoon. How are you doing?
Great, and you? So you are already in Cabo Verde. What threat or what changes has the surfacing of Omicron brought to the arrangement already set aside for this conference?
Yes, it's really unfortunate because the onset of this new variant happened just when several of the participants were en route to Cabo Verde. And we have lost some of our participants. Their travel has been disrupted, and we had originally expected to have more in-person participants than participants operating virtually. But this situation has been reversed as a result of some of the travel restrictions that have been imposed. So it is unfortunate, but however, the meeting is going to continue. It will represent a big improvement over last year's event where the whole event was held virtually. So while we are a little bit disappointed, we're still encouraged by the fact that at least it's hybrid.
And the theme is about Africa's post-COVID development. But with this new variant, should discussion tilt more to surviving this variant or the threat of possible lockdowns or reintroduction of restrictions that could, of course, deter the boosting of economic activities?
Well, this is precisely the focus of the AEC. I think, perhaps the wording may be a little bit confusing, but the real point of the theme is to say you cannot survive the threat of the virus, let alone recover from it without adequate resources. You will recall that, most African countries at the onset of the crisis expended a lot of their resources to fight the virus, even though their fiscal envelope or fiscal resources was not that great. I mean, they had, on average, spent about 2% of their GDP compared to about 12% for the advanced countries, because they don't have the resources. On the one hand, the crisis has led to a decreased demand for their resources, their exports. On the other hand, the expenditures on health and other related expenditures to actually support lives and livelihoods in their own countries has meant that they have been operating on a deficit mode. So several of these countries need resources to survive and also to move forward. And so it's in this context that we're having this conference to discuss how do we mobilize our own resources and also resources externally to make this recovery a meaningful one. If you look at some of the efforts that have been put in place to support countries, both from external sources, one of them being the DSSI, which was really a way to tell countries to stop paying it really gave countries some leeway in terms of when they could repay their debts, the interest on their debt. But this is a temporary measure. It will only focus on low-income countries. However, the pandemic has affected all countries, including the middle-income countries, which account for about 70% of the poor. So we need to go beyond that. Recently, in August, the IMF released what is called special drawing rights. This is really a way to provide liquidity to countries, but it gives countries, larger countries, more resources than countries that have smaller economies. So you see that those that need it most are getting less than those that need it the least. Africa, for example, uses 52% in median terms of its special drawing rights. And then if you compare this to the G7, they use less than 2% of these resources, but they're getting about 60% of these $650 billion. Africa is getting 33 billion. So we need to also discuss, does the global financing architecture really respond to the emerging needs of African countries, particularly in these unprecedented crises? And how do we really have a conversation about changing that architecture to make it more responsive to the needs of developing countries? And then, of course, the issue of access to vaccines is critical to any recovery. And so we're asking the question, how do we ensure that we get some resources to facilitate access to vaccines, but also to facilitate local production of vaccines, which would really be critical to creating jobs while at the same time increasing access to these vaccines. So this is the context in which the theme of this conference was contrived, and we believe that it's really pertinent and germane to the survival of the continent in the context of this unprecedented pandemic.
Well, obviously, you're going to have a very robust discussion, but I guess the next step would be, how do you move from just a talk into implementation? Is it going to be working with countries, or just going to let countries do what they think is right? I guess that would be the next line of thoughts that the conference should be looking at.
Well, of course, financing is the beginning. Access to resources is important, but then also planning how to use and prioritize those resources is critical. And in an era of constrained resources, one has to be very careful about understanding the implications of certain policy decisions. In other words, if you're to recover, what are the key sectors that have the biggest ripple effects or multiply effects on the rest of the country? Because the resources are limited. You can't spread them too thinly because the impact will be limited. So really, there are three fronts. One is supporting countries mobilize the resources needed for the recovery. The second is helping them plan better to understand what are the likely impacts of their policy decisions in terms of the impacts on the economy and on society in general. And the third block is when you spend and make these policy choices, is the execution effective to generate value for money? What are the leakages that are associated with all these implementation efforts? And so the governance aspect is also important. So really it's a threefold package: mobilize resources, plan better, and ensure that the governance mechanisms really lead to value for money in terms of the resources that are expended. And this involves bringing to the discussion civil society to really watchdogs to really ensure that monies are used for what they were intended for.
All right, Mr. Ama, thank you so much for sharing your thoughts with us, and we do wish you, well, successful meetings, and please do stay safe in Cabo Verde. Enjoy the rest of your day.
Thank you very much. You too.
So just before we go on the program, we'd like to tell you that Libya and Niger have signed a memorandum of understanding that seeks to protect migrant workers through effective work visa issuance before employment and to better respond to Libya's labor market needs. That's it on the program. Thank you so much for being a part of it. I'm Ini John Mekwa.